If you're an investor, get ready to cash in on 2025's biggest opportunities. Join Money Smart Basics as we dive into top predictions and strategies to make the most of the wealth boom coming in 2025. Don't miss out. Remember to like and subscribe for more Money Smart Basics videos. If you have any suggestions for financial literacy topics, please leave a comment. Stay until the end to receive a bonus tip. Look in the description below for wealth building tools and income opportunities. You work hard for your money, right? But it shouldn't stop there. You need your money working hard for you. That's what investing is all about, putting your money to work. Think of it like building a financial fortress. Investing is how you lay the bricks one by one to make that fortress strong. A strong fortress needs a solid foundation. That's where diversification comes in. We've all heard the saying, don't put all your eggs in one basket. It's common sense, right? If you drop that basket, you lose everything. The same goes for your money. Diversification means spreading your investments around. It's about not putting all your hopes and dollars into a single stock or even a single type of investment. The stock market can seem like a mysterious beast, full of confusing jargon and unpredictable swings, but don't let that scare you away. At its core, the stock market is simply a place where companies raise money by selling pieces of ownership, called stocks, to the public. When you buy a stock, you're essentially buying a tiny slice of that company. It's like owning a brick in a huge building. Owning stock means you're part owner, sharing in the company's successes and, yes, its failures too. If the company does well, its stock price generally goes up, and your investment grows. If the company struggles, the stock price might fall. It's a roller coaster. But remember, long-term investors are focused on the bigger picture. You'll often hear talk of bull and bear markets. A bull market is when stock prices are generally rising. A bear market is the opposite, when prices are falling. These market cycles are a natural part of investing. A strong economy fuels a bull market. Companies thrive, profits soar, and investors buy stocks. But eventually something happens, maybe inflation rises or a global event shakes confidence. That's when the bears come out to play. Investors get nervous, start selling, and stock prices fall. Seasoned investors know it's also a buying opportunity. They see falling stock prices as a chance to buy quality companies at a discount. The key is to stay calm and stick to your long-term strategy. Section 3, picking your stock's value versus growth. Now let's talk about choosing stocks. Two common approaches are value investing and growth investing. Value investors look for a reliable used car at a bargain price, while growth investors want the latest, fastest model. Value investors hunt for undervalued companies with strong fundamentals. Growth investors seek companies with high growth potential, like tech startups. Both have their merits and risks. Section 1. Building wealth brick by brick real estate investments. Real estate. Just hearing those words conjures up images of solid, tangible assets. It's the ground beneath our feet, the roof over our heads. For generations, it's been a cornerstone of wealth building, and for good reason. Real estate offers a level of stability and control that many other investments simply can't match. Unlike the sometimes fickle stock market, real estate is a physical asset. You can see it, touch it, even live in it. This tangibility provides a sense of security for many investors. Plus, real estate often acts as a hedge against inflation. As the cost of living rises, so too can the value of your property and the rental income it generates. But let's be clear, real estate isn't about getting rich quick. It requires patience, research, and often a bit of sweat equity. Managing properties, dealing with tenants, and navigating the legalities can be demanding. Section 2. Location, 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 residential versus commercial. One of the first decisions you'll face in real estate is choosing between residential and commercial properties. It's like picking a lane on a highway. Both can get you to your destination, but the scenery and the ride will be quite different. Residential real estate, as the name suggests, involves properties designed for people to live in. Think single-family homes, apartments, condos, and townhouses. This sector is driven by fundamental needs. Everyone needs a place to live. making it relatively stable and easier to understand for first-time investors. Commercial real estate, on the other hand, encompasses properties used for business purposes. This broad category includes office buildings, retail spaces, industrial warehouses, hotels, and more. Commercial real estate offers potentially higher returns than residential, but it also comes with higher risks and often requires more significant upfront investment. Location plays a pivotal role in both residential and commercial real estate. Section 3. Beyond the bricks and mortar REITs and real estate crowdfunding. For those seeking exposure to real estate without the hands-on management, there are alternative investment avenues to explore. Real estate investment trusts, or REITs, and real estate crowdfunding platforms offer ways to dip your toes into the property market without the need to become a landlord. REITs are companies that own, operate, or finance income-producing real estate. They are like mutual funds for real estate, allowing you to invest in a diversified portfolio of properties without buying physical assets directly. REITs trade on stock exchanges, making them a liquid investment option, unlike traditional real estate. Real estate crowdfunding platforms, a relatively new kid on the block, connect investors with real estate developers and operators seeking funding for projects. These platforms allow you to invest smaller amounts of money in specific properties or projects, potentially offering diversification and access to deals not typically available to individual investors. Section 1. Venturing into emerging markets, high risk, high reward. So far we've explored familiar territory, stocks, and real estate. Now, let's set sail for more adventurous waters, emerging markets. These are countries experiencing rapid economic growth, often accompanied by significant industrialization and modernization. Think of them as the rising stars of the global economy. Emerging markets offer investors the allure of potentially high returns. As these economies grow, so too can the companies operating within them. This translates to potential stock market gains and investment opportunities not found in more developed markets. It's like getting in on the ground floor of the next big thing. But with great potential comes greater risk. Emerging markets are often politically and economically less stable than their developed counterparts. Section 2. Beyond the headlines, identifying promising emerging economies. Emerging markets are not a monolith. They represent a diverse array of countries, each with its own unique economic landscape, political system, and growth trajectory. Lumping them all together under one umbrella would be like saying all stocks are the same, simply not true. When evaluating emerging markets, it's crucial to look beyond the headlines. Don't just chase the latest hot tip or follow the crowd. Instead, focus on fundamental factors that drive long-term economic growth. Look for countries with a growing middle class. A rising middle class means increased consumer spending, which fuels economic growth. Favorable demographics. A young and growing population provides a larger workforce and a potential consumer base. Infrastructure development. Investments in roads, ports, energy, and telecommunications support economic activity. Political stability and sound governance. A stable political environment and transparent regulations attract foreign investment. Navigating the uncharted waters, investing in emerging markets. Now that we've explored the potential and risks of emerging markets, let's discuss how to actually invest in them. Fortunately, you don't need to be a globe-trotting financier to participate in these exciting opportunities. One common approach is investing in emerging market mutual funds or exchange-traded funds, also known as ETFs. These funds pool money from multiple investors to buy a diversified basket of stocks or bonds from various emerging economies. This provides instant diversification and professional management, making it an attractive option for many investors. Another option is investing directly in the stock markets of specific emerging countries. This approach offers more control and the potential for higher returns, but it also requires more research, due diligence, and risk tolerance. It's crucial to understand the specific regulations, currency risks, and political landscape of each country you invest in. Building your investment all-star team diversification strategies. Remember that old saying, don't put all your eggs in one basket? Well, in the world of investing, diversification is your best defense against a cracked basket. It's about spreading your money across different assets, industries, and even countries to reduce risk and maximize potential returns. Think of it like building an all-star sports team. You wouldn't want a team composed solely of quarterbacks, no matter how talented they are. You need a mix of players with different skills and strengths to cover all the bases and win championships. Your investment portfolio deserves the same strategic approach. Diversification isn't just about owning a bunch of different stocks. It's about strategically allocating your money across different asset classes, such as stocks, bonds, real estate, and commodities. Each asset class has its own risk and return characteristics, and they often move independently of each other. When one asset class is down, others may be up, helping to cushion the blow to your overall portfolio. The Asset Allocation Balancing Act, stocks, bonds, and beyond. Asset allocation is the cornerstone of diversification. It's about deciding what percentage of your portfolio to allocate to different asset classes based on your risk tolerance, time horizon, and financial goals. Think of it like a recipe for investment success. The right mix of ingredients is crucial. Stocks, as we've discussed, offer the potential for high growth, but also come with higher volatility. Bonds, on the other hand, are generally less risky than stocks but offer lower potential returns. They act as a stabilizing force in your portfolio, helping to smooth out the ups and downs of the stock market. Beyond stocks and bonds, consider adding other asset classes to your portfolio for further diversification. Real estate, as we've learned, provides tangible assets and potential rental income. Commodities, such as gold and oil, can act as inflation hedges. Alternative investments, such as private equity or hedge funds, can offer unique opportunities for diversification but often come with higher minimum investments and less liquidity. Time is your greatest ally when it comes to investing. The longer your money has to grow, the more you benefit from the power of compounding. Compounding is like earning interest on your interest. It's a snowball effect that can turn small, consistent investments into significant wealth over time. Think of it like planting a tree. In the beginning, it may seem small and insignificant, but with time, sunshine, and nourishment, it grows stronger, taller, and more resilient. Your investments, like that tree, need time to take root and flourish. Don't get discouraged by short-term market fluctuations. The stock market is like a roller coaster, with its share of ups and downs. Trying to time the market buying low and selling high is incredibly difficult, even for seasoned professionals. Instead, focus on the long game. Establish a regular investment plan and stick with it even when the market gets bumpy. Remember, time is on your side. The earlier you start investing, the more time your money has to compound and grow. Congratulations! You've just completed a crash course in smart investing, exploring everything from the ins and outs of the stock market to the exciting possibilities of emerging markets. Now, it's time to put that knowledge into action and start building your own financial fortress. Remember, investing isn't just for Wall Street gurus or real estate moguls, it's for everyone, regardless of income level or prior experience. The key is to start small, educate yourself, and stay focused on your long-term goals. Think of it as a journey, not a destination. Remember, you don't have to navigate the world of investing alone. Just like you wouldn't hesitate to ask for directions if you were lost, don't be afraid to seek guidance from experienced professionals. Financial advisors, certified planners, and investment professionals can provide valuable insights tailored to your specific needs. Think of a financial advisor as a trusted co-pilot on your investment journey. They can help you develop a personalized investment plan, choose the right investments, navigate market volatility, adjust your portfolio as needed. Finding the right financial advisor is like finding a good mechanic. You want someone trustworthy, knowledgeable, and who understands your needs. Don't hesitate to interview several advisors before choosing one that you feel comfortable working with. In the world of investing, patience is not just a virtue, it's essential. Remember, building wealth takes time. There are no shortcuts, no get-rich-quick schemes, and certainly no guarantees. The stock market, like life, has its share of ups and downs. Don't let short-term fluctuations derail your long-term goals. It's easy to get caught up in the hype of a bull market or panic during a downturn, but remember why you started investing in the first place. Focus on the bigger picture, your financial future, and stay the course. Think of investing like running a marathon, not a sprint. It requires discipline, endurance, and the ability to pace yourself. There will be times when you want to give up, when the market seems daunting and progress feels slow. But just like a marathon runner, you must dig deep, stay focused, and keep moving forward one step at a time. Remember, the journey of 1,000 miles begins with a single step. By taking the time to understand the basics of investing, diversifying your portfolio, and seeking expert guidance when needed, you're already well on your way to achieving your financial goals. Congratulations, you made it to the end of the video. With that, you are ahead of 90% of most people in America. Here is the bonus tip that we promised. Want to know the secret to wealth in 2025? Experts predict unprecedented market growth. Invest now and ride the wave to financial success. Don't miss out. The information in this video is for educational and entertainment purposes only, and is not intended as financial advice. We are not financial advisors, and the content should not be construed as professional financial advice. Always seek the advice of a qualified financial advisor or other professional regarding your specific financial situation. The use of any information provided in this video is solely at your own risk. Please remember to like, subscribe, and comment for more Money Smart Basics videos.